Bankers, realtors, and home builders are beginning to get desperate in today's housing market. How do I know? Because the National Association of Realtors, along with the Mortgage Bankers Association, along with the National Association of Home Builders, all in America, just put together a joint statement that they mailed to the Federal Reserve Bank, begging them to stop raising interest rates, saying that these high interest rates are essentially destroying the housing market. Now, the reason why the Federal Reserve Bank has been working to raise interest rates is a way to cool down inflation. And what the Federal Reserve Bank has said is that they will stop keeping interest rates high when we start to see a real cool down in inflation. Now, before I go deeper into the letter that they put out, let me start by talking about inflation, because just this week we got the latest inflation numbers, and let's dive into how we've seen inflation progress over the last number of months. Going back to April 2023, inflation annually was at 4.9%. May, 4%. June, 3%. So we can see the downward trajectory. Well, in July, it switched. It went up to 3.2%. Then in August, it grows to 3.7%. Then in September, the latest CPI numbers, the latest inflation numbers, says that inflation is at 3.7%. This came in higher than expected. Now, this is where the Federal Reserve Bank will say, well, we don't like to look at CPI, this headline inflation. The Federal Reserve Bank likes to look at what's called core inflation, which is where you take this general inflation and then you pull out what they call volatile numbers, which include energy and which includes food. And this core inflation came in at 4.1%. Now, remember, the Federal Reserve Bank's target for inflation is 2%. So seeing inflation at 3.7 or 4.1%, depending on which measure you use, is a lot higher than what the Federal Reserve Bank wants, which is why the Federal Reserve Bank keeps saying that expect interest rates to stay higher for longer. Now, just so you know, the Federal Reserve Bank is going to be meeting October 31st and November 1st, and on November 1st, they're going to decide if they want to raise interest rates again or not. Right now, the consensus is that they're not going to raise interest rates on November 1st, but we'll see. I'll keep you posted with that. But what are the winners and losers with inflation? What it said was one of the high numbers on inflation was housing costs, shelter costs, which rose 7.2% from a year ago. Now, as a reminder, this isn't the affordability of homes, this is the actual price of homes. So over the last year, shelter costs have gone up 7.2%, in addition to mortgage costs also rising. Food prices grew around 3.7% versus restaurant food has grown by around 6%. And the losers on inflation have been things like used car and truck prices, which have fallen from a year ago, and also energy and gas prices have fallen to help contribute to the lower inflation. But this is where now the Federal Reserve Bank is running into a little bit of a difficulty, because inflation is not coming and staying down. We saw inflation come down in the earlier part of 2023, but then it started to go back up. We saw inflation come down to 3%. Now it's up to 3.7%, and over the last couple of months, it just stayed there. This is what that sticky inflation is that the Federal Reserve Bank keeps talking about, that we've brought inflation down off of the 9% highs, but bringing it down from where we are today to 2% could require more pain. What type of pain? Well, pain in the job market. The Federal Reserve Bank keeps saying that they want to soften the job market because right now the job market is too tight, aka they want more unemployment. And the reason why that's significant today is because with our most recent jobs data, it turns out that employers in America are adding jobs almost twice as fast than what was expected. So we still have a very hot job market. Inflation is not coming down, it's just kind of staying stationary according to the most recent data. And this is where now the Federal Reserve Bank has to make a decision. And this is where now, going back to the beginning of this video, you have the National Association of Realtors, the Mortgage Bankers Association, and the National Association of Home Builders in America coming together, asking the Federal Reserve Bank, or urging the Federal Reserve Bank, I should say, to do two things. Number one, stop raising interest rates. And number two, stop selling off mortgage-backed securities, because this is keeping mortgage rates higher than what they would like to see. Now, before I explain what all this means, I want you to understand this is where your financial education is so important, because you don't want to be one of those people that just panics when they hear the news. You want to be somebody that looks for opportunities. And this is where it's important for you to understand not only what's happening, but also how to find and capitalize on opportunities. We have a free ebook that my team at Briefs Media put together that walks you through the basics of how do you build the mindset of an investor, to then how do you save your first couple $1,000s, to how do you start investing your money, how do you generate cash flow, how do you spend your money smartly, how do you earn more money, and how do you protect your assets. This ebook is completely free. So if you want to get a copy of this ebook and read it for yourself, all you got to do is click the link down in the description description below or go to briefs.co/ebook. Now, diving into the two requests or statements or demands, I should say, by the bankers, the realtors, and the home builders, the first thing they say is stop raising interest rates. Now, the reason for this is pretty straightforward because every time you raise interest rates, it pushes mortgage rates a little bit higher, or it puts upward pressure on mortgage rates. And naturally, when you have higher mortgage rates, that hurts home selling because people are less likely to buy a home at an 8% mortgage than they are at a 3% mortgage. And people don't want to sell their home if they have a 7% or a 3% mortgage and then go and get a 7 or a 7.5% mortgage. So that's why they're, number one, asking to stop raising interest rates. But then the second thing they're asking, which is a little bit more in depth, is they're asking the Federal Reserve Bank to stop selling off their mortgage-backed securities. Now, let me explain what this means and stick with me because this is going to get a little bit technical. When the 2020 pandemic hit, the Federal Reserve Bank went on a buying spree. What did they buy? Well, they went and bought treasuries, meaning they lent money to the government, and they also bought a lot of mortgage-backed securities. And so what that means is mortgage-backed securities are now when if a lender or a bank issues a loan, these loans get bundled up together and then investors can essentially buy these loans, mortgage-backed securities. Now, when you have a lot of buyers for these mortgage-backed securities, the interest rates for these go down because, well, they don't have to necessarily incentivize you to buy it. So if you have a lot of people buying mortgage-backed securities, the interest rate or the mortgage rates go down. But when you have a lot of sellers of mortgage-backed securities because they're worried about the mortgage market, well, now that pushes mortgage rates higher. And between pre-pandemic and the peak of the pandemic, the Federal Reserve Bank saw their balance sheet go from around $4 trillion to almost $9 trillion. What that means is they went out and they bought $4 to $5 trillion worth of treasuries and mortgage-backed securities. This is the Federal Reserve Bank's balance sheet, meaning they printed all this money and they went out and they bought these assets, treasuries and mortgage-backed securities. And this has been contributing to inflation. So one of the ways that the Federal Reserve Bank is fighting inflation is by raising interest rates. The second way is by selling off some of their balance sheet, because this is a way of trying to kind of free up that money. Because when the Federal Reserve Bank has to go and buy these bonds, these mortgage-backed securities or the treasuries, they had to print the money to do that. So now to kind of release this from the system or from the Federal Reserve Bank's balance sheet, they need to release it into the system. And this is where now this is causing higher interest rates and things like the mortgage market, according to the National Association of Realtors, the Mortgage Bankers Association, and the National Association of Home Builders. And this is where they are asking the Federal Reserve Bank to stop selling off these mortgage-backed securities. Well, let me go through the numbers because I think it'll help you understand what's going on. Pre-pandemic, or leading up to the pandemic, the Federal Reserve Bank had a balance sheet of $4 trillion. Meaning they went out and they printed $4 trillion to buy treasuries and mortgage-backed securities. Treasuries are loans you give to the government. Then in 2022, this peaked at just under $9 trillion. Then today, right before me recording this video, I checked the Federal Reserve Bank's balance sheet, and their balance sheet is right around $8.2 trillion. So from the peak in 2022 until now, we have seen the Federal Reserve Bank balance sheet fall by right around $800 billion. And the reason why this is significant is because the Federal Reserve Bank started this quantitative tightening, this selling off of their balance sheet back in 2022. And their goal that they stated was to sell off $500 billion in 2022, and then another $1.1 trillion in 2023. And so that would be right around $1.5 trillion of sell-offs of these types of treasuries and mortgage-backed securities. Well, there hasn't even been $1 trillion of sell-offs of their balance sheet just yet. And Jerome Powell, who's the chairman of the Federal Reserve Bank, has yet to respond to the statement by the National Association of Realtors, the Mortgage Bankers Association, and the National Association of Home Builders. However, chances are he will say something during his statement on the end of October and the first day of November, so we'll be keeping you posted on that. But this is where now understanding how this economic system works, because we are facing much higher yields on things like treasuries and mortgage-backed securities, mortgage rates. And the question is, what is the impact of this going to be? Now you can see that people involved in the housing market are getting worried about the higher mortgage rates because the Federal Reserve Bank has been saying over the last number of weeks, Expect interest rates to stay higher for longer. Expect these rates to stay around. So now naturally, if you are a lender, or if you are a home builder, or if you're a realtor, that signals bad news for the market, because that means less people are buying. If less people are buying, that means less commissions. And this is so where they're trying to now go to the Federal Reserve Bank saying, hey, are you sure about that? That's going to hurt the housing market. That could break our housing market. That could really affect our economy. That could hurt our whole economic system. That could affect the GDP. So they're making their claims now saying, hey, Federal Reserve Bank, don't do that. I think it's time to start lowering and start stimulating again. But the consequence of lower mortgage rates, the consequence of not doing this quantitative tightening is higher inflation. Remember what I said just a couple minutes ago. One of the highest levels in the CPI, the inflation number, was housing costs. Housing costs, shelter costs, have gone up by 7.2% over the last 12 months. That's not factoring in the growth in mortgage rates. So imagine now what would happen tomorrow if mortgage rates got cut in half. You have a lot of buyers in the market. If you had a lot of buyers in the market, what would that do? You'd see more bidding wars. If you see more bidding wars, what's that going to do? Home prices are going to go up. If home prices go up, what does that mean? People are going to have more equity in their homes. If people have more equity in their homes, what does that mean? People can pull that cash out refinance. If people do more cash out refinances, what does that mean? People have more money for shopping, vacations, eating out, cars. If people start spending money like that again, what does that mean? The prices of things go even higher. And this is where you can start to see that tough fight that the Federal Reserve Bank is facing, and why bringing inflation down to that 2% is going to be more difficult than what the Federal Reserve Bank expected. Big surprise. And this is where now it is important for you to be more financially educated and understand the consequences of the higher interest rates, understand the consequences of inflation, and understand what it would take to actually go down to 2% inflation, and understand not only what economic struggles that could cause, but also how that could create investment opportunities for you, because your job is to be a financially educated investor, not to be a panicker or a worrier. And that's where I want you to use this time to, number one, build your financial education, and number two, build your financial preparedness. And that's why I keep saying 2023 is not the year for you to go out and finance a new truck. 2023 is the year for you to get financially smart and build that financial cushion and build that financial education.